Having worked in economic development for over 20 years at the local level, one program that I benefited from a lot was the 504 program. In Wisconsin, we have two Wisconsin-based organizations that operate the program. Joining us today is Jason Manette, who is Senior Vice President and Senior Lender at WBD Incorporated. They have offices across Wisconsin. Jason is also on the WIDA board and is my president-elect of the association. So Jason, thanks for sharing your time today, and also thank you your time with WIDA throughout the year.
Thank you very much, Brian. It's my pleasure to join you today. I also want to thank Michael for his efforts in getting this webinar launched. We appreciate the opportunity to present. I want to thank my fellow presenters for the excellent insight they provided thus far. And most of all, I'd like to say a warm WIDA welcome to all those that are in attendance. I wish I could be saying that to you in person, of course. The Certified Development Company, or 504 loan program, is really SBA's vehicle to finance real estate and equipment projects with long-term fixed rates with low down payments. It is accessed through the Certified Development Company, and we'll talk about those two in a moment. Right now, we are offering long-term fixed rates of up to 25 years at historically low rates, near 3%. The two CDCs active in the state, organized in the state, I should say, include, of course, ourselves and the business lending partners. And there's contact information here and at the end of the presentation. How will we help with this recovery from the pandemic? We've already talked quite a bit about the 6 months of SBA made payments for existing 504 borrowers. We, as a certified development company, are also able to approve up to 6-month deferments for existing borrowers. So we have an opportunity here to potentially allow borrowers to go payment free for up to 12 months, which obviously will be a welcome opportunity. Looking forward, as the other ways we can help are restructuring debt for borrowers that already have loans that were taken out to acquire real estate or equipment. We can convert those using the 504 refinance program, extend terms, extend amortization, and provide access to those historically unprecedented long-term fixed rates. We can also continue to offer access to the 504 regular program for new real estate and equipment projects for small businesses around the state. The sweet spot for using the 504 program is a total project of $300,000 or greater for real estate and equipment use. And I apologize, I'm dealing with a little bit of a sensitive mouse here as I advance the slides. The typical 504 structure is shown here. We can work with as little as 10% borrower contribution. The bank or credit union finances a first mortgage position loan for 50% of the project. We finance up to 40% at that long-term fixed rate. You can see here's an example of a conventional down payment where a lender may require as much as 25%. On $1 million project, the 504 could save down payment of approximately $150,000 by reducing the down payment requirement to 10%, thus allowing the borrower to preserve working capital for other uses as they grow. We can also be flexible as to the source of a borrower's contribution into a 504 project. Again, it can be as little as 10%. Business or personal cash qualify. We can also, in some instances, use loans that are secured by other assets or that are long-term in nature. Those can include loans from a seller in the event of an acquisition, also municipal loans or potentially loans secured by TIF proceeds, which we'll look at in just a moment. Importantly, we can also use existing real estate equity as contribution into an expansion project, and we do that quite often to minimize the cash that the borrower has to bring into the expansion. There are certain instances where we need additional borrower contribution. I won't belabor these, but basically if it's a startup business that's been in operation for less than 2 years, or a special use property such as a convenience store or a hotel, that triggers an additional 5% contribution in each of those instances. Again, long-term patient financing is the real play here, similar to 7A, but perhaps different in that our portion is a long-term fixed rate, again, up to 25 years for real estate projects. We also have a 20-year product, and there's also a 10-year debenture product that is used for shorter-term equipment, keeping in mind that if you have long-lived equipment, we can also qualify that potentially for a 20 or 25-year term and amortization on the 504 side. Just quickly on eligibility, it's going to mirror what was talked a little bit earlier, but any active for-profit business, new or existing, the size standards that we generally use are the tangible net worth of the applicant and its affiliated businesses per their tax returns has to be less than $15 million. And that's, of course, after all tax adjustments, depreciation, et cetera, are accounted for in the net worth. And the same thing for the average net income. Again, it has to be less than $5 million after taxes, depreciation, et cetera, are all accounted for. There are a few ineligibles. Most notably, we can't do investment properties where the tenant is not related. So strip malls, et cetera, not eligible for the program. We also can't do housing projects other than those that provide senior living services such as RCACs and CBRFs. Eligibility in terms of the use of funds is related, all fixed asset related costs are eligible. Acquisition of real estate and equipment, some related soft costs. We can do some refinance in conjunction with an expansion. As an example, if a borrower is undertaking $1 million expansion and has an existing $500,000 loan, we can roll those into one 504 project. And we can also do standalone refinance, which we'll cover in just a moment. Ineligible things are working capital, inventory, current assets, goodwill, and those types of things that are not fixed asset related. Maximum size standards are, loan amounts. We can go up to $5 million to our borrowers on our portion of the financing in all instances. Even a borrower that has accessed the maximum $3.75 million in SBA 7(a) guaranteed authority still has the availability to use the 504 program. In addition to that, SBA is screaming at us to do projects for manufacturers and those that are using green energy technology. We can go up to $5.5 million per project to manufacturers. So we are being incented or being asked to do projects again and again and again to those manufacturers. And a similar situation applies to green projects. They can use the program. They are capped at a total of $16.5 million in financing on our portion of the project, but again, can leverage some very large transactions. We got some amazing rate and terms on the refi program. Again, this is a situation where we view the opportunity for borrowers to refinance existing debt on very favorable terms. If they're just refinancing what we call a qualified debt, we can lend up to 90% loan to value. If they're looking to take some cash out to use some proceeds for other business expenses, we can lend up to 85% in the 504 structure, and they can cash out, if you will, up to 20% of the appraised value. It's important, we must have a qualified debt to use the refi program. Most notably, that loan has to have been in place for at least 2 years, current for the last 12 months on all payments, and we have to be able to show that it was originally used at least 85% for eligible fixed asset acquisition or improvement. We're going to have to be able to obtain the documentation behind that. And the last 2 bullet points are important. As we sit today, we cannot refinance any existing federal loan guarantees with the 504 refi program. So no SBA 7(a), no USDA as an example. We can also not refinance an existing 504 loan. In terms of the business expenses, we can be very flexible with that up to 20% that can be included. We can project out up to 18 months in the future to capture those. So it's fairly easy to do. The borrower can also use any of the cash out proceeds to pay down an existing line of credit immediately. So that 20% is fairly user-friendly in terms of accessing some quasi-permanent working capital, if you will, over an extended term and repayment period. Quickly, some case studies. The first actually involves collaboration with WEDC as well as our cooperating lender and the municipality involved here. We had a wholesaler and custom automotive parts manufacturer that was looking to repurpose a large former retail building. Project was located in a TIF district. The acquisition cost was $3 million with construction roughly 2.4 and equipment needs of 500,000. We were able to structure the project using a variety of programs. This was an existing business and a multi-use property, so it was only required to come in with 10% contribution. You can see that WEDC funds via the Idle Sites grant accounted for about $217,000 of the required contribution. And in this case, the lender was actually able to provide a loan secured by an assignment of the TIF proceeds. They advanced at 75% of the overall pay-go TIF proceeds to be repaid over time, and that provided another chunk of the borrower's contribution. So this is an example. We have a $6.1 million project for a growing company, and they were able to get into the deal with about $125,000 injection, plus the other very helpful resources that they brought to bear. We also have a ground-up construction project, and this one was, again, looking at a new location, needed higher ceilings and a larger facility. They needed to acquire the land and do the construction. And even though this would have qualified for a 10% contribution. The lender, based on the projections and the growth here, wanted to see 15% down. So we structured it as follows. Of note, the city's contribution of the land for $1 purchase price, we were able to bring that in at the appraised value. So that accounted for a good chunk of the borrower's required contribution on this. Borrower ended up reducing their occupancy costs from rental payments of $17,000 a month down to $10,000 under this scenario. Last but not least, I did want to provide an example of a 504 refinance project where the borrower took cash out. So the existing mortgage for this property was around $1.1 million, and they had significant evergreen line of credit balance of over $2.2 million. So what we looked to do was try to pull as much of the cash out as possible. The appraised value on the facility came in at $2.87 million. So as you can see, we were able to refinance the existing mortgage and max out the cash out portion at $574,000 to allow them to reduce that line of credit. So a nice opportunity for the borrower to tap into the equity they had in fixed assets and again, help restructure their debt on a more friendly long-term basis. Very quickly on approval process, we have about a 30-day process from when we have the information we need and the lender approval is on board to get through the CDC approval process and on to SBA authorization. We underwrite an application package and forms are available on both our website and BLP's website. And this is just a quick snapshot of the financial, personal, and project information that's needed. Most of this overlaps with what a bank would require. There are a few dedicated forms. And finally, here again is the contact information for the CDCs located in Wisconsin. Thanks so much for your time and attention today.